In our previous session, we discussed valuation of shares. Today, we are going to explore a new topic, valuation of equity shares. In this session, we will continue learning about share valuation. This time, we will explore the key methods and principles behind equity valuation. Have you ever wondered how can investors determine the true worth of a company's shares? And what role do growth expectations and market conditions play in shaping their value? At the end of this topic, you will be able to define key concepts of equity valuation. You'll be able to explain the significance of equity valuation. You'll be able to demonstrate the use of valuation techniques. Equity shares represent ownership in a company. They are the foundation of a company's capital structure and grant shareholders the right to share in the company's profits, vote in its decision-making processes, and claim residual assets in case of liquidation. Investors typically purchase equity shares for two key reasons. Number one, dividends, which is to earn regular income as a return on investment. And second is capital gains, which means to sell the shares at a higher price in the future. Unlike bonds or preference shares, equity shares do not guarantee fixed returns. Instead, they offer the potential for higher gains and align investors' interest with the growth and profitability of the company. The valuation of equity shares involves determining the intrinsic value of a company's shares based on its financial performance, growth potential, and other fundamental factors. This intrinsic value helps investors assess whether the shares are overvalued, undervalued, or fairly priced in the market. This helps investors make informed decisions on whether to buy, hold, or sell shares. The intrinsic value calculation guides companies in assessing their worth for mergers, acquisitions, or issuing new shares. We will further explore key approaches and methods used to value equity shares like dividend capitalization method, book value approach, liquidation value, and price earnings ratio. One of the primary approaches to valuing equity shares is the dividend capitalization model. Let us now discuss the method in detail. In this method, the value of an equity share is determined by discounting the future stream of dividends and the resale value at an appropriate rate of return. This approach functions on two basic premises or assumptions. First, dividends are paid annually, and second, the first dividend payment is made 1 year after the purchase of the share. This method provides for two types of calculations. One is single period valuation and second is multi-period valuation. Let us take up each of these methods now. First is single period valuation. This model is used when an investor plans to hold the share for 1 year. The formula is the current market price of an equity share denoted as P naught is equals to the sum of two components. First, the present value of the expected dividend to be received after 1 year, which is calculated by dividing the expected dividend, denoted as D1, by 1 plus the required rate of return denoted as KE, raised to the power 1. Second, the present value of the expected price of the share after 1 year, which is calculated by dividing the expected future price of the share denoted as P1, by 1 plus the required rate of return denoted as KE, raised to the power 1. Together, these two components provide the current value of the share reflecting both the income from dividends and the potential capital gains from selling the share in the future. Let us solve a quick problem based on single period valuation here. Considering this XYZ India Limited share is expected to touch rupees 450 1 year from now. The company is expected to declare a dividend of rupees 25 per share. What is the price at which an investor would be willing to buy if his or her required rate of return is 15%? So as per the question, we need to calculate the purchase price of share at 15% required return. As per the given information, we have D1 expected dividend after 1 year as rupees 25, KE the required rate of return as 15%, expected price of the share after 1 year, that means P1 as rupees 450. Putting all these values in the formula, we get P naught is equals to inside the bracket 25 divided by 1 plus 0.15 plus inside the bracket 450 divided by 1 plus 0.15. Solving this equation gives us rupees 413.04. So we can say that an investor requiring the return at 15% would be willing to buy the share at rupees 413.04 rupees. Let us move forward and discuss multi-period valuation. Since an equity share can be held at an indefinite period as it has no maturity date, the value of such shares held over an indefinite period can be calculated by adding the present value of dividend. If the share is held for a finite period, the present value of the resale price at the end of this period is added to the present value sum of dividend for the same period. Now, another approach for valuing the share is based on its dividends. There are three types of dividend, and the valuation of equity shares vary in each case. Three types are: first, constant dividends; second, constant growth in dividends; third, changing growth rates of dividends. Let us look at each of these in detail. First, let us talk about valuation of equity shares with constant dividends. First, let us understand what constant dividends mean. Constant dividends refer to a scenario where a company pays the same amount of dividend to its shareholders every year without any variation. This method assumes that the dividends amount remain constant indefinitely, making it easier to calculate the intrinsic value of a share. The formula for calculating the value in this case is P naught is equals to D divided by KE. Here, P naught is equals to current market price of the share, D is equals to annual dividend, which is constant, and KE, which is required rate of return or cost of equity. Let us solve one question here. Suppose a company pays a constant dividend of 10 rupees per share annually. If the required rate of return KE is 8%, what is the value of the share? To solve, we have to analyze the given information first. As per the question, D is rupees 10 and KE is 8%, that means 0.08. Substituting the values in the formula, P naught is equals to D divided by KE, we get P naught is equals to 10 divided by 0.08, which gives a value of rupees 125 rupees. We get P naught is equals to 10 divided by 0.08, which gives a value of rupees 125. This means an investor would be willing to pay rupees 125 for the share based on the fixed dividend payout. Moving on to the next method of valuation, with constant growth in dividends, this tells us how to value shares when dividends are expected to grow at a constant rate over time. In this case, the formula is P naught is equals to D divided by KE minus G. The intrinsic value of a share with constant growth in dividends is determined using this formula. Here P naught represents the current value of the share, D1 is the dividend expected in the next year, KE is the required rate of return, and the G is the annual growth rate of the dividends. Let's work through an example. You need to determine the value of the share if the expected dividend for the next year is rupees 5 and the dividend growth rate is 4% while the required rate of return is 10%. Using the information provided in the question, we know D1 is equals to rupees 5, KE is equals to 10% or 0.10, and lastly G is equals to 4% or 0.04. Substituting these value in the formula, P naught is equals to D divided by KE minus G, we get P naught is equals to 5 divided by 0.10 minus 0.04. Upon simplification, we get the share value of rupees 83.33. Now we will discuss the valuation of equity shares when dividends do not grow at a constant rate indefinitely. Unlike the constant growth model, this approach accounts for companies experiencing varying growth rates over time. This method is particularly useful for businesses in dynamic industries or those undergoing transitions such as startups or firms in highly competitive markets. In such firms, there are periods during which the dividends may grow supernormally, that is, the growth rate is very high when the demand for the company's products is very high. After a certain period of time, the growth rate may fall to normal levels when the returns fall due to fall in demand for products, which is with competition setting in or due to availability of the substitutes. Valuing shares with the changing growth involves dividing the growth period into distinct phases. First, we calculate the present value of dividends during the supernormal growth period. This is done by summing up each year's expected dividend, denoted as DT, divided by 1 plus the required rate of return, which is KE, raised to the power of that year T. Next, we determine the present value of the shares price at the end of the supernormal growth phase, denoted by PN, based on the stable growth rate GN. This is done by taking the dividend expected immediately after the supernormal growth period, expressed as DEN plus 1. Dividing it by difference between the required rate of return KE and the normal growth rate, which is GN. Discount the obtained value of PN to the present value by dividing it with 1 plus the required rate of return retake. Discount the obtained value of Pn to present value by dividing it with 1 plus the required rate of return, which is Ke, raised to the power of n. Finally, these values are combined to derive the share price today. Let us take an example here. Say a company is expected to pay dividends of rupees 4, rupees 5 and rupees 6 in the next 3 years during a supernormal growth phase. After that, dividends will grow at a constant rate of 5% annually. The required rate of return is 10%. We need to calculate the intrinsic value of the share. Step 1. Given. D1 is equals to rupees 4, D2 is equals to rupees 5 and D3 is equals to rupees 6. After year 3, dividends grow at 5% annually. Required rate of return, which is R, is equals to 10%. To calculate the value of the share at the end of the 3-year, we use the Gordon growth model because dividends will grow at a constant rate from year 4 onwards. The dividend in year 4 is 6 rupees multiplied by 1.05, which gives 6 rupees and 30 paise. The value at the end of year 3, called P3, is then 6 rupees and 30 paise divided by the difference between the 10% and 5%, which equals 126 rupees. Next, we calculate the present value of all expected cash flows. This includes the dividends of 4, 5 and 6 rupees in the first 3 years and the future share value of 126 rupees at the end of the year 3. We discount each of these amounts back to today's using the required rate of return of 10%. So we divide each amount by 1.1 raised to the power of its year. Adding all the present value gives an intrinsic value of 107 rupees and 18 paise. In addition to the dividend valuation approaches discussed in the previous section, there are other approaches to valuation of shares based on the ratio approach. First is book value approach. The book value per share, which is BVPS, is the net worth of the company divided by number of outstanding equity shares. Net worth is represented by the total sum of paid-up equity shares, reserves and surplus. Alternatively, this can also be calculated as the amount per share on the sale of the assets of the company by their exact book value minus all liabilities including preference shares. The liquidation value per share is calculated as value realized by liquidating all assets minus amount to be paid to all the credit and preference shares. The liquidation value per share is calculated as inside the bracket value realized by liquidating all assets minus inside the bracket amount to be paid to all the credit and preference shares divided by number of outstanding shares. The price earnings ratio reflects the amount investors are willing to pay for each rupee of earnings. Expected earnings per share is equals to expected PAT minus preference dividend divided by number of outstanding shares. Expected PAT is dependent on a number of factors like sales, gross profit margin, depreciation and interest and tax rates. The price earnings ratio has to consider factors like growth rate, stability of earnings, company size, company management team and dividend payout ratio. To sum up, in this session we have learned key terms such as market value, intrinsic value, price to earnings, that is PE ratio, etc. We have also learned the importance of equity valuation in making informed investment decisions, assessing a company's financial health and estimating future growth potential. We have also learned applications of methods such as dividend capitalization method to calculate the fair value of equity shares. That's all for today. Thank you and happy learning.